This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Correction or Crash, Part 2. What do we have here on the second page but an S&P futures continuous chart? What's going on?
Right. So last week we talked about how horrible the market breadth was and how the S&P 500 wasn't really reflecting accurately quite how deep and how significant of a correction that we already saw. So here on the S&P chart, we're just I have that 50-day moving average and also highlighted in the green box the 50% retracement as well as where the previous highs were. And based on just purely textbook technical analysis, the market simply retraced down to its average price. All previous highs acted as support. The correction lasted a typical several week mean reversion correction and is already attempting to bull breakout all over again. And so far, you have to give it to the correction camp and that this really does look like it has turned back up. Now, we're coming to a pretty critical moment because always as you approach a previous high, there's famous patterns like double tops or fake out breakouts like to create head of a head and shoulders pattern type of thing that could always occur. But right now, the pattern of dips being bought and new highs being made remain intact. And while Julian made a pretty good case that why the equity markets could run into some risk, at least at this moment, I don't see much technical reasons to believe that that's the case. And so right now, I think over the very short term, I'm willing to give the bulls the benefit of the doubt that they're going to be able to bust this towards 48, 4,900 on the upside. But Julian makes a good enough case that I'm going to be paying attention and looking for that canary in the coal mine that something isn't working out that way.
Well, let's take a look at the VIX on page 3 because, boy, it was through the roof and it seems like it's most of the way through a full retracement.
Right. And so whenever we get those kind of Charlie McElligot's quants on talking about option positioning, one of the things that is always observed is that when you have huge spikes in volatility, that once that volatility starts to normalize, it creates a tailwind behind the markets known as VANA, which is as volatility is contracting, it actually reduces the amount of short positioning dealers have to have, and it actually pushes the market higher. So arguably, the first impulses higher on the market were given this tailwind. Now it's really going to be a question as to whether the bulls can build on this initial slingshot higher and whether the market itself breaks to a higher high. Like when we look at page 4, where I have that percentage of stocks above their 50-day moving average on the New York Stock Exchange, you can see that we were at the lowest level since the COVID crash on this metric in just a 2-week S&P correction that was just a mere couple hundred S&P points. It's amazing how the breadth of the market deteriorated so significantly, but it was oversold enough that typically marks a tradable bottom. And so this to me supports the idea that markets may still have a bit of a Santa Claus rally to go over the next couple of weeks that may even push the market to higher highs. While I do again see potential risks in the new year for the equity markets, at least on the short term, it looks like the bulls have the control of this market on the short term.
Let's move on to my favorite chart on page 5, crude oil futures.
Right. And well, first of all, that was such a devastating drop in late November that basically did some significant technical damage. But at least on this January contract, you can see how we traded right back down to the summer lows of crude oil. I mean, it just barely printed as low as the August low, which was all the way down at 61. But there was inevitable that the market was going to get a reflexive rally, which is when something is so oversold, it's just reflexive to be able to mean revert or retrace some of the drop. But here we are at about a 50% retracement of the entire drop. Yeah, we rallied about $10 from the intraday low to where we are today. And this is actually the real kind of make it or break it level in my mind, Eric, because if this was just a reflexive snap and that still double bottoms or more consolidations in store, this is exactly the level where we could go back to $68 or $65 and go back and retest some of those places we were just trading a week ago to establish a tradable low. Really important moment here in crude oil. What's your take on it?
Patrick, I will defer to your wisdom as the technician and short-term trader. My view fundamentally is this whole thing was about a panic over Omicron might be the strain that shuts the global economy down to the point where there's global lockdowns and air travel ceases again, and we go to negative oil prices. That's what brought this all on, and we've seen the equity market retrace pretty much completely. The crude oil market's only retraced half of the drop, and I don't see any evidence to tell me so far that Omicron is a really big deal. It seems like it's a very big deal in the sense of its transmissibility. Almost everybody is going to get it. But it sounds to me like this one really is what the media was trying to tell us was happening at the beginning of the real pandemic, when they said, look, it's just going to be a bad flu and there's nothing more to it than that. It sounds to me like Omicron really is the one that's going to be just a bad flu and something that maybe almost everybody's going to get, might even help with herd immunity. Once we figure all of that out, I think that the fundamentals are definitely in place to get us above $85 by next summer, probably sooner than that. And I think it's possible that we could get well over 100 by next summer. Now, as far as whether or not we go back down and test, I don't think we go back to a new low below $62. Do we go back down to 65? I don't know. Probably only take a headline or two to get us down there. And I wouldn't expect it to last long. Let's move on to gold futures on page 6. Patrick, tell me about this consolidation. I mean, it's been quite a while.
Absolutely. And so first of all, we're usually looking at daily charts. This is a weekly chart. So we're trying to grasp 3+ years of data on here, showing including the huge 2019 to 2020 run in gold that we took it from like 1,200 to 2,100 on the upside. We've been obviously in a very deep consolidation. And just like we were talking in the market wrap at the beginning, there was a breakout. And there was a breakout that happened. It was the same level that you and Ole Hansen were talking about, some of those key consolidation highs that was advertising a potential beginning of a next bull leg in gold. That got very quickly derailed. And this entire pullback on gold over the last 3 weeks did enough technical damage to say with at least a reasonable high degree that it was a false start on the upside. But just because it was a false start on the upside doesn't necessarily make it bearish. It simply is much more likely that gold is going to stay in this purgatory trade range. Vulnerability down to the low 1700s is now entirely possible. But I think that the bigger picture stance we have on gold remains somewhat intact, so long as the trade range is contained and the gold prices stay winding up for ultimately the catalyst for it to go higher. Maybe it just is going to be a second quarter 2022 story, and gold is just going to stay in this trade range for throughout the remainder of the year and to start next year. But I don't think I want to tilt bearishly yet. It's certainly just gold has failed to start bulling higher.
Let's move on to the Chinese A50 stock index on page 7.
Right. And so I'm curious if that Evergrande default finally was like the sentiment shift that was needed to tilt the market. What's interesting about the China A50 was that it's truly been the global equity market that has kind of marched to the beat of its own drum. The rest of the global equities have more or less been correlated to some degree or another. And while China remained in somewhat of a bear market decline for the better part of the entire year. And what we really have seen throughout the latter part of the summer, mostly in the third quarter and into this fourth quarter, was the Chinese market was really basing. And even all of these negative headlines that have been coming out simply weren't hurting their equity market anymore. And this pattern really starts to look like a very traditional technical one called the cup and handle formation at the bottom. And we're really seeing now that the China A50 is trying to break out. And a couple days doesn't make a new trend, but this is how they often begin. And it's really interesting to see whether or not this is the turning point in China.
What's happening to Bitcoin on page 8, Patrick?
Well, it's interesting. I was arguing about how Bitcoin was actually behaving pretty well right up into the middle of November, and how generally it was holding fib zones and could bullishly break out. But really, the last week when Bitcoin broke down below 55,000 with a legit breakdown, that was serious technical damage that changed the technical profile of Bitcoin. And the fact that it kind of crashed the downside, almost like crude oil did in some degree or another, and just like a rapid liquidity event that wiped out 10,000 plus points in a span of 24 hours. But the snapback and reflexive rally did happen, just the way it happened on other markets like crude oil. But it really so far looks pretty weak, and it looks like it's rolling over. And really, while I don't want to make an outright bear call out here, I would say this, that the bulls really need to get this Bitcoin north of 55,000 on the short term to neutralize the sell cycle. Every day Bitcoin stays below that level, the more likely it is that there's another leg coming to the downside, and maybe something under 40,000 that we'll have to take in order to establish a new tradable low. But this chart has really shifted in the last week, and all the bull cases can now be at least temporarily taken off the table.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day with a free trial of Big Picture Trading. Information is on page 9 of the slide deck or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.